Welcome to the cage fight between Warren Buffett and Robert Kiyosaki. Which one has better investment advice? Which one is easier to follow? Which one is going to make you more money? Let's explore that right now. My name's Cliff. I'm the author of the book Entrepreneur Power Up, and I'm the host of the Power Up book channel here on YouTube and an executive MBA. All right, in one corner we have Warren Buffett, the Oracle of Omaha. Warren Buffett owns Berkshire Hathaway, which is a holding company of many company stocks, and he's considered to be the best at what he does. He's one of the richest men in the entire world. There's a lot of reasons to listen to him. On the other corner, we have Robert Kiyosaki. Robert Kiyosaki is a rich investor. He is the author of one of the best-selling books, Rich Dad, Poor Dad, and owns Rich Dad, Poor Dad Company, as well as many other assets like gold mines and tons of real estate. They both have very different things to say about how you should spend your money and invest it. Let's get started. Let's talk about their assets first. Warren Buffett's assets are all in stocks. He does own other companies as well, but really most of what he's known for is stocks. He's a big investor in owning all types of stocks and funds that pay dividends. His favorite index is the S&P 500. His philosophy is to measure all types of things with the companies. He likes companies that are transparent, that are profitable. He does a lot of mathematical equations on future value of their stock and the income that the company is going to be bringing in, and makes really good choices on which companies to invest in. Warren Buffett's investment strategies are really simple compared to all the mathematics that he and his team end up doing to measure the value of companies they invest in. Basically, if a company is good enough to make it on the S&P 500, you've got Warren Buffett's attention. And if he can understand what your company does and what your product does, that is absolutely extra credit. Now, the assets of Robert Kiyosaki are a lot different. Robert Kiyosaki hates stocks. He hates things that are backed by the American dollar. Because the American dollar is subject to so much inflation lately, he believes stocks are subject to a lot of inflation as well. So he is very anti-stock. Robert Kiyosaki likes to invest in things like gold, silver, cattle, Bitcoin, things that are finite. Real estate is finite as well. Robert Kiyosaki owns a ton of real estate, so those are his assets. And assets for Robert Kiyosaki are things like real estate that actually make income as well. Now, that's very similar to dividend stocks that Warren Buffett owns. But with assets like real estate, they're subject to a different market, and the taxes are a bit different for how real estate works compared to how stocks work. And I'll be talking about that later in this video. So let's talk about the type of investment advice that these two give. Warren Buffett gives very simple investment advice on his videos on which indexes to buy stocks on and which stocks to buy and for certain companies. And it's pretty simple if you just read the reports that he sends to his shareholders. He breaks it down on what his advice is. His advice is pretty easy to follow. You set up a brokerage account, you look at similar things that he looks at with these companies. You even pick the same companies that he picks. For most people, that's a winning combination. It's easy. Warren Buffett also doesn't fall for any type of trendy, unproven technology or companies. For example, during the dot-com gold rush back in the end of last century and the beginning of the 2000s, Warren Buffett did not lose hardly any money in that dot-com bubble when it burst because he didn't invest in many of those companies. And the reason being is those companies didn't meet the criteria for Warren Buffett. He didn't understand the technology. There was no income or cash flow or any type of revenue to prove that these companies were viable. So Warren Buffett didn't invest in them. On the other hand, Robert Kiyosaki gives investment advice about buying things that bring you money. So real estate is his favorite thing, but he also advises people to buy businesses that make money, such as car washes, owning a dry cleaning business, things that are automated somewhat and don't take as much manpower to operate. He likes those type of businesses. A lot of his books are about how to acquire real estate and how to start businesses like this. He even is a fan of multi-level marketing businesses, which are not popular with a lot of people once they get into them because they're very hard to be successful in, and they tend to irritate all your friends and family. All that aside, though, Robert Kiyosaki wants people to acquire assets and not acquire liabilities. He doesn't want people to buy things like boats and toys and things that just cost people tons of money. He wants people to buy things that make them money, so that way that money can be used to buy other things or invest in different things. As far as taxes, who pays more taxes between the two of them? Well, that's very difficult to answer. Warren Buffett pays himself a salary of $100,000. He once said that his secretary paid a higher tax rate than him. That doesn't mean she paid more in taxes, it just meant that her rate is higher. Now, why is this? It's because of this reason. The way our tax laws are set up in the United States, employees pay a higher tax rate than someone who is an investor who owns a business. So, for example, the tax rate for someone who is single or maybe even married, filed jointly with an employment income can be anywhere from 22 to 34% depending on how much money they're making. Now, Warren Buffett, on the other hand, gets a lot of his income from dividend stocks. Tax rates for dividend stocks and long-term sales of stocks is actually pretty low. It can be as low as 15%. So that's much less compared to someone that is getting taxed at a rate of 25% based on their income. So it pays to make your money off of dividend stocks as well as long-term gains. And what I mean by long-term gains, I mean you buy some stock and you hold it and then you wait at least a year before selling it. That's long-term gains. Now, if you sell your stock before a year, that is called short-term gains, and the tax rate is 40% for short-term gains. So you don't want to sell anything before 12 months. Kiyosaki, on the other hand, brags that he avoids most of the taxes, and how he makes his money tax-free is that he owns all of these assets like real estate, for example, and he will go to a bank and show the bank his balance sheet that he's making tons of money off of these assets, and he owns all this equity from this real estate. And so the bank will give him a loan with the interest rate, and he will take out a big, huge loan. He takes out tens of millions of dollars, probably up to almost $1 billion at this point. And I think maybe it's even more if you catch some of his latest interviews. He likes to brag about that. So when a bank gives someone a loan in the United States, based on assets, that money on that loan is tax-free. So in other words, if I own $1 million in assets and I go to the bank and I get a $500,000 loan based off of those assets, then my assets will pay back those payments to the bank plus interest, and then I get a $500,000 interest-free to spend however I want. That's the power of getting tax-free income. It's not very common, but Kiyosaki loves to brag about this. Okay, so which one is more accessible and easier to implement as far as acquiring these assets and making money? On the one hand, with Warren Buffett, you just open a brokerage account and you just go for it. You look at what he's investing in, you look at the S&P 500, and you start choosing some winners. You buy some mutual funds, maybe some funds that invest in several of those funds, and you buy those and hold them. And if they go up in value, you decide to sell them after a year, you pay 15% taxes on those capital gains. Better yet, if you can save up money and buy dividend stocks, you can make passive income off of those dividend stocks that pay you every quarter. And that's a great way to make money at a low tax rate. I would say for Warren Buffett, conceptually, it's pretty easy to implement that strategy. It's a matter of just opening an account and having the money to do it, right? Okay, let's talk about Robert Kiyosaki and how he tells you should do this. Kiyosaki says you should buy real estate and own rental homes and assets like that that make money for you. The challenge for that is that it's easier to open a brokerage account and put some money into stocks than it is to save up a down payment for a rental home. So I'd say as accessibility, it's a lot easier to go with Warren Buffett's method. However, to have enough money to buy dividend stocks that would make you a decent amount of passive income would be quite a bit of money, and that would be similar to what you would be able to spend to get a loan to purchase a home or apartment building or a duplex or some type of real estate that you can make money off of. You can also buy funds or purchase gold and silver on its own and hold on to it while it goes up in value. But that's, again, a long play. And it's something that you may want to just wait a while to cash in on. And so that satisfaction may not come as soon as being able to buy stocks and watch those go up and split, or buying dividend stocks and starting to make money on those dividends every quarter. I do like Kiyosaki's philosophy, though, that if you do own assets and you want to buy a nice car, for example, you own assets that are making you money, whether it's a business or real estate investment, and then you go to the bank and you get a loan based on those assets. Your loan is tax-free, you go and buy the car that you want, and then your assets pay that bank loan back. And then after, let's say, a couple years, that car is paid off, and you still own those assets that continue to make you money. That's really smart, and I can see why that's a very popular way to handle your money and to look for ways to buy more things with that money. It's just harder to implement. I would say in the end, Warren Buffett is more popular. He's definitely way more wealthy than Robert Kiyosaki, and he's not controversial like Robert Kiyosaki. But at the same time, I think you can learn a lot from Robert Kiyosaki. With Kiyosaki, you can get assets, though, that can give you leverage to get into things that you could not get into before. It's not as easy to go to a bank and say, I have a lot of stocks and they're being held right now and they're not making me any money, but I'd like to borrow some money. That's going to be hard to do. However, if you go to a bank and say, I'm making this much cash flow because I own a bunch of assets that are actually making me money, whether it's businesses or real estate, then the bank is going to give you that loan, which you can use to buy more assets or more businesses. So I'd say with Kiyosaki, that's a really smart play. It really just depends on what you want to do. Do you want to acquire more assets, or do you want to put money away towards retirement and become wealthy that way? That's fine. If you want to buy assets and really take some fast tracks into buying more assets and getting money that's tax-free, then Kiyosaki's way is better for you. Let me know in the comments what you think.